Before we get started with today's show, I just want to take a couple minutes to talk about Permissionless 4, the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. Be sure to act real quick there to get the best deal. All right, back to the show. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. All right, everybody. Welcome back to another Roundup edition of Forward Guidance with the trio is back. Tyler, you're back. Welcome back, my man. We missed you a lot.
Yeah,
how are you?
I miss you guys. I'm pretty anxious. I gotta say.
You got some nerves? Been a little bit since you did this.
Yeah, I gotta shake these cobwebs off.
Yeah, I can see the rust building up on you.
Yeah, I got some grays. Jesus, it's like,
That's actually a good thing because sometimes when it's just been Quinn and I, we've been getting roasted for just being a couple of young bucks that don't know anything. So I'm glad you got some gray hairs to bring to the table for us.
Yeah. Look at Quinn's like, what is this? A 90s mushroom top haircut? Look at the flow. Look at the flow.
Look at that, man.
Is there a man bun? Is there a man bun back there?
I could get some cornrows. We'll see. I get a haircut on Friday, so we'll
oh man. You should let it run. Yeah, Tyler, you got your playoff beard on. That's what's going on.
Things must be going well at Blockworks because last time I talked, Felix was in like a dungeon of an apartment. Now he's got like some paintings on the wall and shit.
I know. I got some Matisse going. I got a little lighting block thing here too. We're really up in the game. No. What happened is that we hired a head of podcasts who's gotten our shit together. So we have a bit less of a, kind of just thrown together shop. So yeah, we're definitely leveling up, but
it was all our bearish calls that got all the views because we turned full bear and people, that make when you're a doomer, your view counts just skyrocket. So Felix was probably just
I heard it's Bearsville here and I'm about to turn that around.
Thank God. No, yeah, we got burned a little bit too hard last week, being a little too bearish, I'll admit. And that's always what's so hard. I don't know, like we're pretty good at calling the bottom and getting that. And then, this is just a classic scenario where you just overthink everything too much. And it's just like, once you get the price in and you get the bottom, sometimes it's just best to log off and kind of just run with it. But yeah, you're definitely guilty of overthinking it sometimes and getting chopped up and caught up. And
oh my God, you got a call wrong. One in like 4 months. Like people on Twitter can shut up. That's why we got the man in the arena up here. A lot of people.
Yeah. What an original poem, The Man in the Arena, that no finance guy has ever put on their shelf.
Yeah.
I'm gonna be nice. It's your first show back.
Rock back on the show.
This is what happens when we get a little too bearish in 1 week. Suddenly Mike just calls up Tyler and he's like, you got to get back on there and teach these kids a lesson or something.
Start talking about Kathy Woodstock, Rocket Labs.
Hey, we're going to be the 10-minute section on Rocket Labs today.
Yeah, we got to get the update. Okay, let's get into let's chat a little bit here. I don't even remember when you left us, Tyler, but a lot has happened in the past few months. We went through a whole entire tariff war.
I left at the top, and then I'll come back when the bull market comes again. Just
there you go. People probably just thought you sold the top and left.
Yeah, we're about to break out here, but yeah, you go.
Okay, well, let's chat. So basically, we recorded the last roundup right before we got this China deal, and in that episode, we kind of threw around like, okay, what's the best case scenario for this China talk over the weekend? And we're like, okay, maybe cutting down to 50% or something like that, and might see a few basis points of an uptick based on that, but. No, it came out, I think it exceeded most people's expectations. So we got a US and China struck a 90-day deal to roll back tariffs. We've seen them both establish basically 10% reciprocal tariffs and then an additional 20% on the US side for fentanyl-related stuff, which nets out to 30. And yeah, on the Chinese side, we've seen things go from 125 to 10. And yeah, that cut a lot of left tail risks overall and set us up pretty nicely. Is pretty important, I think, to get some sort of agreement, because as we saw, like I had Craig Fuller on the show last week, and he's a shipping logistics expert and was talking about how, yeah, basically there's an entire embargo between China and the US, and there's just, nothing was leaving ports in any direction whatsoever. And that's just not sustainable. So by all means, great news. Tyler, what's been your framework the last couple of months as you've thought through this tariff war and everything that's happened? Like, what's been your guiding light throughout all of this?
Well, markets, you have to manage risk, obviously. So you got to watch the fixed income markets. We can talk about, high yield CDS and credit spreads and how those portended the entire story. But the baseline is, number one, we're in a Ponzi scheme. And number two, markets are now a political utility. They are not free markets. So like, if you're under those premises and you're just looking at market indicators, that's way better than being a fundamental analyst these days. Like, it's all about flows and systematic investing now and buybacks rather than any of those other things. So it's that for the framework is watch credit spreads, watch volatility, and know when you're in the buyback blackout windows or not. And so that's sort of how, I've thought about managing this past couple months. It's definitely rocky and not easy, but I think I can show you a bunch of charts later why I think that framework actually works. Because the long story short is Trump tried to reverse, the capital to labor giant 40-year cycle in under like a month. And clearly you can't do that. So, the markets took it as draconian, and, now he walks it back and we're right back where we are in centralization land. So, in a world that's centralized, and you can see what power politics has, which is just kind of crazy. But that's where I am right now. I'll let Quinn take over. And what do you think about, Quinn?
I just want to hear you. This is
Quinn's in the doghouse this week.
I don't want to speak too much too soon.
Nah, this is the Tyler show. So it's interesting. Trump didn't really tout the China deal much past a day. Like, he kind of just, he's obviously in the Middle East. They're pretty busy, but I don't buy that it's a deal. I think it's far from a deal. I think it's a pause. I think things heat back up when the pause is over. And it just shows people, all of his haters who were kind of freaking out and pointing fun at the art of the deal, sort of got in a way, because he's got at this point, I don't think he will both have his cake and eat it too indefinitely, but up until now he has. Because if in 2018, think of that tariff war when he was announcing 5, 10, 15% tariffs and the market freaked. And this time he's like, well, we know that's not going to work. So we have to hit people over the head and then roll back to 30 because we shifted the Overton window so hard that this is where we'll land. Let's be honest, 30% tariff is not a good place to be with your largest trading partner of, decades with supply chains embedded. So that it's not over is my point or belief. But yeah.
It is a pretty wild, Overton window shift. To your point, even with this pause, this is just looking at where we're at now in this effective tariff rate. We got, Liberation Day, we went up to 30%, and then we've been ratcheting backwards, but we're landing at currently 12.5%, and the market is euphoric on that. So I think that's a pretty interesting point just to look at that. And it's interesting too, we're starting to actually see tariffs get collected. You can see in this chart of just U.S. custom duties revenue, and absolutely soaring. So things are happening. It's just obviously on the spectrum of how large we're going at it. And obviously when you got a 30% effective tariff rate and an embargo with your largest, the second largest economy in the world, that's not sustainable. And then the Ponzi starts to show fractures like Tyler was saying. But yeah, we are also shifted not entirely back. And there is a certain portion of that policy that is looking like it'll remain to a certain degree, whether that's 10%, maybe, but yeah, we're here still.
This is going to be such a long-term cycle, but it's clear, like we saw the blow off top in something is what we saw. And I don't know. I have a strong suspicion that, labor's share of the financialized pie is going to be slowly growing from here as inflation expectations set in, and generationally yields are stubborn, or you have to have some sort of yield curve control policy. But it's clear we've passed some Maginot line here on the inflationary expectations. I think longer term, shorter term, it's actually coming down. So that's why I'm rather bullish.
I think that is the big question here, is how long cyclically, we're seeing some downward pressure on the economy, and that's obviously affected inflation, but the structural issues don't really go away. So I think that's the $1 million question here, because at some point, you run out of how many deals you can cut with Middle Eastern countries to pump more oil and suppress the price. And eventually the domestic producers who all were Trump supporters are going to revolt and say, dude, you're killing us. Like the Dallas, the Texans and everybody, like they're getting wrecked. And so there's a rubber band you can pull on certain parts of this strategy so hard. But markets are loving it. So
Tyler, I think it's time for some Tyler charts.
Yeah.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com. If you want to walk us through, what do you got? We miss these.
All right, this is a long diatribe. This is from Deutsche Bank, but if you want to read along, you can. But this is slide 22. It says the U.S. cannot close its very large current account deficit, the trade deficit, unless it closes the fiscal deficit too. But over the last few days, we are learning something very important. The U.S. appears to be unwilling to do that. The emerging reconciliation bill from U.S. Congress points to an ever-wide fiscal deficits above 6%. The U.S.-China trade accord effectively signals a very low pain threshold, tariffing the U.S. consumer. In all, even if we account for the now diminished revenues from tariffs, the U.S. budget deficit will keep growing. The current account deficit will likely keep widening in this scenario too. The significance of this conclusion cannot be overstated. We've been arguing over the last few months that the market is reducing its willingness to fund U.S. twin deficits. This is arguably entirely reasonable given the expressed U.S. desire to reduce them. But actions speak louder than words. The news flow over the last few days aligns with the opposite outcome. We worry this is brewing a major problem for the dollar and potentially the U.S. bond market too. The rationale is as follows. The U.S. has a record negative net international investment position, chart 1, the most rapidly deteriorating largest in the world, chart 2. Let's go to those two first charts. This is slide 23, and then we can continue. So if you look at figure 1 is the U.S. external asset position is on a dangerous path. So it shows you the net investment position as a percentage of GDP. So we're negative 100% GDP, which means all these foreigners are invested in U.S. assets. And then on a relative basis, figure 2 shows you it's already the largest deficit in the world. So everybody in the world has piled in. At the end of last year, we saw the blow off top, the Trump euphoria, blah, yada, yada. And, we gave into that too, obviously, a bit, where all foreign investors push their money into the U.S. That's the baseline. If you go back, I'll finish the rest of it, though. This is reflexive of three things: very large foreign ownership of U.S. assets, extreme valuation of dollar assets, and the very expensive dollar itself. Running a wider fiscal deficit requires foreigners to buy an ever-expanding amount of U.S. treasuries and an ongoing rise of Americans' foreign liabilities. This we believe is no longer sustainable. To see this, consider our long-held argument that the best metric of fiscal space is a country's net international investment position. The greater the amount of money a country owes to the rest of the world, the more difficult it is to borrow more money. This can be seen in the very tight relationship between sovereign yields and the net investment position, far tighter than the corresponding relationship to fiscal deficits. The current path of America's deteriorating net foreign asset position implies U.S. Treasury yields well above 5% over the next few years. We believe foreigners are becoming increasingly aware of this dynamic as the dollar has lost some of its special status. Let's go to those two charts for a second. This is slide 24. So you can see, this is the next one. There you go. Too many foreign liabilities are very expensive. So like you can see at negative 100% GDP, the US already had a very strong currency at that point. And now at that point, it's very hard to issue more and more debt because everyone's already piled into the US. So like the more and more debt, the higher the yields are going to be going. Where the hell, and this is like my general feeling, I feel like we're at this Wile E. Coyote moment, like generationally. And where do you put your money? I've said this for years, but like bonds make no sense to me at all. Like, why would I ever put my money in a bond as a 40-year-old? That's kind of crazy to think. Like, why would I buy debt? Why am I incentivized to buy debt when the government's just like profligate and they can't unwind this? Like, you had a reason when Trump was cutting everything, right? And he was making the dollar go super spike, but now you don't. Like, he couldn't even do it. So you're basically stuck in the Ponzi. And where do you go in the Ponzi? You go to, we're finding out Bitcoin, the correlations attached from like stocks. Gold is now performing, stores of value are performing now. And you also have, obviously, tech stocks are their growth is good enough to stay. So I think there's this moment where, boomers are still systematically investing in bonds because of insurance, all these like huge institutions have to buy debt just to play not to lose. So like if you think about when you're 70 years old and you're retired, you're essentially playing not to lose at that point. But like for someone like us, we're going to be incentivized to play to win. And so that's why you have to own these super high vol risk assets like Bitcoin. And I think that's like, there's one trade in my mind, which is if the most trusted collateral on earth is losing value, like Deutsche Bank is saying here, and I think a lot of other people are coming to that conclusion. And we're watching like Bitcoin is knocking on the door of new highs, which is, and no one's talking about it. And now you have the entire administration behind it. So I don't know. You got to play the Ponzi. It's just that here's this other thing with a really tight supply that's a better Ponzi to me. So like that's where I'd probably have a large concentration at this point.
Boom.
Yeah,
man. I've been thinking a lot about this stuff too, and trying to, because like this is the biggest of the big money. It's the big institutional allocators, and those ships do not just change overnight. So it's been really interesting to see, obviously, in the last couple of months where we had these days of market correlations where it's like bond yields up, US dollar down, US equities down, and you could just see that it's capital outflowing from the US. And at the same time, you're seeing like a lot of rest of world equities, like Europe's been doing super well this year. But to me, that still feels like it's just the speculative capital. It's just the fast money, hedge fund money that's just quickly front running that. And the big institutional capital that we see in these like, net investment positions and stuff, that still hasn't really changed yet. And now where I'm at is trying to figure out, okay, how much of this is just beginning? How much of it is just, getting a little too doomery and saying, oh, look, the US dollar is about to unravel and, you got to go buy gold, buy Bitcoin, even buy euros, and that, just diversify your FX reserve positions. And, you can see where if you go all in on this idea, you could probably easily get caught up in the last couple of weeks where we just see like systematic, like short covering and that sort of thing, and people going in to buy the dip on Mag 7. And that's sort of where my head is at now, is trying to figure out how much do I incorporate this in versus being like, okay, nothing ever happens and we'll probably just go back to how things were before. But I do tend to agree with you that it feels like the genie is out of the bottle in some respects. So yeah, like how do you navigate those two worlds? Yeah.
Go look at slide 26. This is why macro is so powerful. And most guys are bottom up, but now you have to be a macro investor before anything. Okay, so this is year-to-date returns. And this doesn't make any sense from a fundamental perspective. You're probably baffled by this because the DAX is up 27% year to date, and that's in US dollars. But here's where it gets really funky. Yeah, if you currency adjust it. So like this, I currency adjusted this. So like if you look at the TLT in Japanese yen, like that's who's been selling treasuries and repatriating money. So the TLT in Japanese yen is down 9%. And so like you don't get compensated to own duration, like any long duration bonds, if you're an international investor. That was the whole premise of the Deutsche Bank thing I was trying to get across, is like, so like you're devaluing your currency. So like, and you only get, I don't know, 4% on the 10-year, the TLT is the 20-year, but so somewhere in between there, you're losing money. Like you're going to perennially be losing money. So why don't you just reinvest it back? This is why this is a generational thing that we're watching here. They're repatriating money back home. And that's exactly what's happening. If you do, DAX returns in US dollars, it's up 27% year to date, which is like mind blowing, right? And they're now incentivizing with a, $500 billion infrastructure plan, nominal growth back home. So this is all like a reversal of globalization, globalization was essentially just to, you created massive elites on the coasts because all those guys wanted, Louis Gove says this, they wanted their mansions in the Hamptons to be $20 million instead of $2 million. And the price you paid to do that is you hollowed out the American middle class. And now all those things are unraveling. That was probably a little bit roundabout, but like you can see it here. The money is now repatriating home and they're no longer recycling those assets back into US markets. Now, the most fascinating part about this, which makes no sense to any fundamental investor on the planet, it is, and I wasn't able to talk about this a year ago at my last fund, but MicroStrategy was like one of our biggest positions, obviously. And it defies anything in financial markets. The one thing it makes sense is if you're looking at this from a demographic and volatility perspective, it makes so much sense. It's up 37%, which doesn't, on the surface, you're like, how is MicroStrategy up 37% this year? But it's been a safe haven for your money relatively because it monetizes the volatility. It's taking into account all of the macro dynamics and political dynamics that are happening. And that's becoming a store of value. It's happened over a long enough period of time now where people who hate on him and just watch one of his earnings releases. It's mind-boggling what he's doing. He's arbing the boomer Ponzi scheme. That's what he's doing. And that's a simplified version of what he's doing, but that's really what's happening. And the only way to stay ahead of this like dilution and these giant debt problems on the government balance sheet and boomers cornering asset markets, there's a few ways of doing it. But like if you're a US investor, you have to be vol forward. You have to have you can't just ride the Mag 7. You're just staying, even with everybody by doing that. So I'll stop on my diatribe there.
Tyler, what do you think if someone says whatever the problem, like if someone were to say, okay, yeah, these problems in US assets are big, but Japan's debt burden's even larger. Europe has been in recession for like, maybe a year plus now. And, likely worse off economy. Do you have any views on dollar versus the currency pairs on a relative, maybe longer term, it's maybe dollar bearish, but near term, do you think that trade's overdone, or you think it's just this like perpetual outflow from US assets that weakens the dollar? Like, and how do you pair, maybe you weren't talking about stocks breaking out here, but
Yeah.
you're mentioning you're bullish on maybe it's just Bitcoin and not stocks. But then how do you pair that view with your NASDAQ view, I guess?
I think we're closer to some sort of like Weimar Germany type inflationary thing than we think. And everyone's having a hard time staying above the inflation. Like you can feel it. You can feel it. I have 3 children. My healthcare costs are more than my mortgage. I mean, this is ludicrous. I mean, it's and I locked in my mortgage when rates were really low. So I think the only way out of this at this point is you have to be in a store of value, whether that is tech stocks or Bitcoin or, something that has an inherent inflation protection in it. Cause like nothing else makes sense in terms of the dollar, like in a secular downtrend. Yeah, I think it is at this point. I think Trump destabilized the capital system as we know it, even though, we might temporarily be going back to it right now.
Well, yeah, on that point, that's where I've been, because as we mentioned in that first diatribe, there's the current account deficit, so like goods, but then there's also the other side of the equation, which is the capital surplus of US dollars going out to the rest of the world. And so now we're in the situation where, okay, they talked about wanting to narrow the current account deficit by basically tariffing goods. But as we're seeing is that there's a certain limit of what you can actually do there. Like 10%, the economy can probably survive through that, but at 30%, there's no chance. So, what if we flip to the other side of that balance sheet and start looking at capital controls? It was really interesting. We should talk about this, but there's the next big narrative is going to be this fiscal bill that's coming up. And in there's stuff like, taxes on remittances to other countries from US dollars and that sort of thing. And this is like full on capital controls. And that's sort of leading towards, I think, what you're saying, which is this Weimar-esque situation. And I think a lot of people, when they hear that, they expect it to come from the Fed. They think the Fed's just going to print a shit ton of money. But in reality, I think it's entirely more likely that it's going to be the fiscal side of things, the Congress people that want to just keep the Ponzi going because that's how they stay reelected, right? So, just look at this potential bill right now. Like, we're in the complete opposite situation from a few months ago where the narrative was, Doge cutting $1 trillion and, balancing the budget, even though we said on the podcast that was a ridiculous idea and we go into a depression. Like, now we're quickly seeing here just in some of these forecasts it's the complete opposite situation. The deficits are going to rise further. I have this chart too, and I think I saw that you put it in here as well, Tyler, but just looking at the percentage GDP fiscal deficit, if this bill goes through. So we're at 7% GDP deficit right now. With this bill, we would see a net deficit expansion up to 8%. So this is going up, not down.
Yeah.
Doge is done. The game continues. The Congress people want to win midterms.
I mean, Doge, they can still cut from like places that are funneling money, laundering money. That's great. But I think the problems are so big at this point that you get in this nominal GDP targeting cycle. And I think what I'm saying is they're going to have to do yield curve control, and basically the money that will come from the bond market into equities, the great rotation, that's very possible. Where if you have some sort of infrastructure plan or, tax holiday or whatever, they'll manufacture something to get stocks higher. And that's just the world we're living in right now. Is stock market is effectively a piggy bank for, the next generation's like lifestyle, because you can't save. I can't save, 4% on the 10-year and pay my kids, daycare bill that's going up 15% every year. It's just not possible.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the #1 institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure notes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to arkham.com to start tracking wallets, following flows, and trading with an edge.
I just think they're in this cycle where, you know, inflation rises, but they have to keep the bond yields down one way or another to finance the government. And you inevitably end up just annihilating the dollar at this point. You've pushed it as far as it can go. And Trump will come up with policies that'll probably help the journey, and it'll be rocky. But largely, I think we're in one direction. And I do think Bitcoin and gold are sniffing this out. Like I think those are the two most important assets to pay attention to right now, because global collateral is being reanalyzed here. And if you have a trade balance now, are you going to put all that money right back into US Treasuries in this, you know, going back to the point about the new fiscal deficit? Like, I don't know. Would you?
Yeah. Well, let's talk about the constraints and the breaking point, because obviously the bond market is what's constraining things right now. When the 30-year hit 5%, you know, Trump called it the bond market getting a little yippy. That's when this whole thing reversed. And so here we are right now, where yields have started to go up again. We're getting close to the yippy levels again. But I'm curious how you guys are thinking about where that level is, where, you know, something like yield curve control needs to come in. Is it the velocity of it? Is it when the 10-year gets to 6%? Like, what do you guys think?
I think it's the velocity. I mean, we're actually seeing, if you look at high yield CDS, it's actually come in quite a bit. This is slide 27. Just from a market structure perspective, like, this is when the systematic guys come in and start buying everything. You know, we saw it blast off to 500, and now it's completely receded. So like, I don't know. I think we're in kind of like a Goldilocks here for a little while, as, you know, the buyback season's here. I don't think this is like, you have to be really scared of like a rate spike here in the short term.
I think it's going to become a problem this year. The supply problems are well known, and this budget, I think, accelerates the awareness of that because of its 180 pivot from what the rhetoric was to start the Trump administration. And so many points that Tyler made, I agree with, around the attempt at some level of reining in fiscal largesse and austerity measures to control the unraveling of the fiscal situation and put the US on a more sustainable path forward. And it is very telling of the problem that it caused this much damage when someone tried to attempt to fix it. And my excitement around their administration, which I think they're still doing a lot of good things for Americans, but it was a lot around it's physically impossible. And I find it also an interesting data point that in this moment, as well as the Liz Truss England moment, everyone wants to blame it on one person, as if Trump came in and destroyed a 100-year-old plus bond market on his own. Like, if that's possible from one person, it says a lot about how strong the actual foundation is of that market. And the reality, as we all know, is, these deficits have been building for a long, long time. So I think it's going to be a big problem this year. And I think what people are missing is, yes, there's some cyclical downward pressure on inflation here, and that may allow the Fed to cut, say, 2 times. But what happens if this, I view this U.S. outflows trade is I'm not sure how much I buy the rest of the world going to be able to do well. But if, Tyler, what you laid out is right about the overallocation to U.S. assets, both equities and treasuries, it's kind of like a years-long TWAP out of our
Yes.
and then that's not like, it's like everyone has to be so black and white, like bull bear, like we're going down straight 10% in a line, or we're going up to 6,500 in a straight line. It's like, but in reality, I think when the administration learned their lesson a bit and to not be so chaotic and violent without so as to not break things, the next downturn could just be like plus 5 bips on the 10 or 30 year every day for in perpetuity, and stocks just grind down. So I don't, I don't know. I don't think we're going to have the same dramatic violence in the near term either, but I don't, because of this problem, a lot of which you lay out, I don't see a very good outcome or reason to be super bullish.
Check this out. Check out, you gotta hit me with slide 28. Because like the stocks going down thing is like, to me, this is the buyback chart. And I jacked a lot of stuff from Deutsche Bank this week. I don't normally look at their stuff, to be honest. But look at the weekly announced buybacks for the S&P. It's up and to the right. So when you have periods of low volatility like what you do right now, everyone's still short the market and you just get constantly squeezed out. And this is just going to keep happening. The only time buybacks stop is around earnings season and when credit spreads widen, because everyone just puts their buybacks on hold. So like, I don't think, this has defied any, like everyone's talking about recession and now we're back at the highs again.
Yeah. Same with the passive flows thing, right? Like unless the unemployment rate explodes, which it's, we're still at max employment, those people are still getting their paychecks and putting on their 401ks every week.
This isn't defying anything though. This is like, if it's analogous to any bear market, it's analogous to any V recovery. We don't know is the point.
Yeah. Yeah. I think that's what's always so hard. It's really hard to tell in the moment, is this a bear market rally or the start of a bull market? Because they both happen the same way, which is what we're seeing right now.
You know what I think we're seeing is if this is like the heart rate of a patient and you get these brief spurts of, like normally your heart rate goes doop, doop, doop. And now we're seeing like doop, doop, doop. Because like it's the volatility comes in spades. And then it just, what happens is all these stupid systematic investors, because they only manage to one thing, which is volatility, they self-reinforce everything on the way up. If you looked at the sentiment like studies, it looks like that was the bottom of COVID we just saw. So I'm like kind of bullish here. Just if you look at any of the sentiment surveys, it's like off the charts.
There's like the Barron's magazine cover that was like, what happened to all the bulls?
Yeah. And so the systematic guys haven't even fully, gotten back in yet. And, a lot of the hedge funds, they took their net books down. So they're massively short this market too. I think the most painful thing is if you just see it grind higher on like low vol here and you're watching implied.
This is where you have to decide whether to trade against your own macro though, because like you showed in the beginning of this is, okay, you have the unwind of all of this dollar flow that's been going into US assets for so many years. If that reverses and goes back home and gets repatriated, either you need to be bearish US equities and long rest of world equities. But to Quinn's point, there's a lot of issues over there too. And, you have to take speculative views on that side of things. And that's where I get back to this point of, it feels like, and this is like this Bitcoin thesis I wrote at like 78K or whatever it was a few weeks ago, was laying this out, that every other subcomponent, I feel like there's something I have to discount or be worried about. Like, yes, I want to go buy US tech, but I'm also going against my own macro, which is telling me that money is going to flow out of it. Or I could just go buy Bitcoin, and that feels like the cleanest trade out of them all.
The reason you want to buy US tech is your bias and rear view mirror.
Exactly.
If you approach it from first principles, I think you arrive at a different conclusion, because we're sitting here and it's like, dip comes down, buy NASDAQ. And in reality, you're like, look at everything else. Okay, the NASDAQ bounced, yes, but look at everything else that bounced way harder.
Exactly. Yeah.
Okay. I'm going to play devil's advocate to that, because I just read something today that blew my absolute mind. I think it's not necessarily a good thing, but the path of AI is increasing at like an exponential rate. And like that could make the centralized players way more powerful. Like you could essentially run Facebook, Meta, Google at, a tenth of the size and still have the same effect with AI. So like, it's really hard to sell tech. Like, and not only that, but they can financially manipulate their stocks like magicians. Like they already have low floats. It's in the productivity boom potentially coming from AI is crazy. This is written by this whiz kid. His name is Leopold Ashbrenner in June of 2024. It's called Situational Awareness, and he basically is saying like, no one is understanding how this could be like the 21st century productivity boom, where like it changes the world for everybody in under like 3 years. So like, given all of our macro themes, if AI actually works like it does, maybe tech is behaving exactly like it should. Meaning, they're the ones, the large centralized players that can utilize this stuff fastest will have the biggest advantage. And it's in the next industrial revolution type of thing, where we went from horses to cars. Now we're going from computation to AI. That's my only contra there. Where
yeah, I'm super sympathetic to that.
You're like, oh my god, and then you look at this guy's background. He's like graduated valedictorian at the top of his class, like clearly brilliant whiz kid, and it makes a lot of sense. It makes a lot of sense where we could be in like a massive productivity boom, and everyone's talking about like, from the debt side of things, everyone's concerned about all these things, but we could just be in the fourth industrial revolution. We don't even know it.
Yeah. I mean, did you guys see the interview? Like Paul Tudor Jones went on CNBC a few weeks ago and was just like crashing out about AI. He was just like, man, like I was just in this conference with some heavy hitters from tech, and why is nobody talking about this? This is literally society changing.
Yeah.
Aggressively.
I mean, like, think about it. Like I have 3 children, and I'm genuinely concerned my job will be obsolete in like 5 years. Like, not joking. I've already seen it get cannibalized in a lot of senses. Like, a lot of my career has been watching, like, when you watch spreads come down and the access costs of things hit like zero. Like, you can trade stocks for free now. Like there used to be an access thing. Like realtors, the one thing they did right was they basically put up this union where they still keep their fees, even though what they do is, largely commoditized. So maybe it's just putting up roadblocks to stop innovation.
As long as humans are involved, though, you have amounts of opportunity that exist to be taken advantage of.
Politics and influence become way bigger. Like, that's why this podcast, we got to grow it big enough where the AIs can't control us.
Yeah, but we could be deep fakes right now. Our audience may not even realize that. We could be not real. Who knows?
Yeah, this could be a fake Tyler that's back. It's not even a real him.
Yeah, exactly.
He hasn't said dong, Vietnamese dong.
He hasn't talked about the Vietnamese dong yet. We don't know. He hasn't talked about Rocket Labs.
If you look at the TLT returns in dong, man, they're pretty bad. Think about that. Think about the ramifications of that.
Wait. I actually want to ask you about the Asian currencies while we're on it. You probably saw the move a couple of weeks ago of the Taiwan dollar. What was your reaction to that?
Well, I was watching that Asian dollar. What was interesting was when all this stuff was going down, if you looked at the Asian dollar currency basket, that thing that we watched months ago, that was actually getting inflows. So, you're seeing the repatriation out of US assets back to Asian markets, and it wasn't deflationary, meaning like the thing that my old boss, Mark Hart, would watch was if, you get the devaluation of the Chinese yuan, and then you'd have this super spike in deflation, the dollar super spikes high, you have massive deflationary repercussions when the yuan revalues lower. And that wasn't happening, which basically means like money was actually flowing into these Asian markets, and that's not deflationary. So that was the interesting part about this whole thing to me was, we saw credit spreads blow out, but we did not get deflationary impulses, which is probably why, stock markets are back, where they are now.
Underlying all of that too is obviously we've talked about the trade deals in terms of tariffs, but it feels like the big one is the currency agreements, because there's been all these Asian currencies that have just been artificially too weak for so long. And basically like, talking about the valid parts of what the Trump admin is trying to go after, artificially weakening your currency to just dump a bunch of cheap crap into the US at the cost of the middle class is a very valid concern. So to me, when I see something like the Taiwan dollar, especially, which is obviously going to be interconnected to negotiations between the US and China on what happens to Taiwan, I'm like, are people front running this? Are they, caught unhedged on their currency exposure? Yeah. And I don't know. Like, do you think there's going to be any sort of currency agreements? Obviously, you're bearish dollar, but
I think this is where you go back to markets are a political utility. As soon as you hit an extreme imbalance, the politicians get together, and it might not be a Bretton Woods type agreement, but it's going to be like, hey, the dollar's too weak. Let's, do something to cause some inflows. Or, hey, tax holiday, Saudi Arabia can invest $500 billion, or UAE invest $500 billion in the US, and you get capital inflows somehow. There's going to be all sorts of this stuff for the next 30 years. But at the end of the day, I just think we've set in motion an entirely new system here. It's clear that, from my perspective, you have this thing that everyone's kind of agreeing on. Like Bitcoin is becoming that. It's leading the pack in a relative world. Is leading everything else, and I think that becomes the chokehold for the next century of economics. I believe. I think that's really what we're watching. So to me, there's all this time and energy that goes into fundamental analysis of each company right now is just seems kind of futile to me. Like I think you're better off thinking about things geopolitically and about big capital flows, because you can make 10x in Bitcoin over the next 3 or 5 years, and you'll squeak out a 7% gain, in the S&P. I just nothing makes sense to me to where to put your attention anymore.
Yeah. It feels like, I don't know, the generational trade is short bonds, long Bitcoin. Quinn, are you still short bonds, or what are you out there?
Yeah, I am. I'm short. Have some protection on via long twos as well. And
how much do you make short bonds? I think that's the other thing. Is like the risk reward of shorting bonds kind of stinks.
Not if you structure it appropriately.
Yeah, do you do it through options or something?
I think there's interesting ways. Like you can bet on the steepener, for example, without. I mean, not to say anything is without risk at all ever. You're taking risk. That's the only way you make money. But I think there's ways to cover. If you have a view that this debt supply thing is a problem and going to worsen if this bill passes, that view can be short bonds in a booming economy and growth, and stocks are ripping and yields are spiking, and okay. Or you can also have it long twos against and say, we're going to go into maybe you think you're going into a slowdown and the Fed's late to cut and there's a recession, and you get a natural steepener, so you're more protected. I think how you structure it is really important, because those are two very different outcomes. I think we just saw, what the market, in my opinion, actually is pricing in more than the China news, because I don't think the China news was that material relative to expectations. It was obviously better a little, but I don't think it was, up 6% better. Was the pivot in the spending bill? Was the
Agreed,
pivot
100%?
That is what I have been a bit late to. The policy coming into the year very much influenced the bearish view on assets. I'm not bullish, by the way, and I have views that vary, but it's much, it's rotational. Pick your asset classes correctly, pick your currencies correctly. And I think there's a lot more interesting things to be betting on right now than the stock market.
You know what I'm bullish on?
Although I'm taking bets on the stock market too.
I'm bullish on your Hugh Grant, like little floppy hair thing you got going on there. Very bullish.
We'll see, man. I'll have it up in a man bun for you next week.
Yes.
We'll see. It's hot down here. It's summertime.
Felix got his Oilers hat, like just generic.
Dude, I was
a Canadian was my Oilers hat.
Dude,
Go Oilers.
We just made it into the Western Conference Finals, and I went to a game last week in Edmonton. This thing's not coming off for at least another month.
We're so happy to have you back, Tyler.
Yeah, man, we missed you. You're a savage. Keeping us humble too.
Yeah, I missed you guys. This is always keeps me on my toes.
That's good. Yeah, it's a good way to stay at the top. Yeah, man. Well, yeah, excited to do this again next week and the week after. We're stoked to have you back. The trio's back, and yeah.
Tyler, you got to come to New York for the permissionless in June.
Permissionless. You know what? There's a 96% chance I'll be there.
Dude, you say this every time and never.
No, I really mean it. Okay, probably too much information, but my son has a serious heart condition, and we can't have a hard time leaving home because he had this thing in his arm. It's like kind of like a diabetes pump. It is really hard to travel with him when he has it, and so there's a trial drug we got him on, and we got him off the pump. So things are a lot easier in my life now, and I can probably travel a little bit more. So just
amazing. There you go.
Too much information for the audience.
Was that thanks to your boy RFK?
No. This is new drug he's got for pulmonary hypertension. He's got, but his heart was backwards when he was a kid, when he's a baby. And anyway,
I'm glad things are improving for you guys. That's awesome.
Sorry, you got that part out too.
We're kidding the forward guidance listeners.
Real life
GoFundMe link for the forward guidance listeners.
Yeah. Hey, GoFundMe for a flight to permissionless.
No, we gotta get you there, or else we're gonna have Mike jump in again, and he's gonna just every time he's like, "Man, I haven't looked at macro in a little while." So.
Yeah, I want to get Mike back out here. We're going to do a full guys and
we'll pull him in it too. We got to do the quad. That'll be fun.
By the way, how was the last DAS that I missed? Was that
amazing? You missed a good one. That was like one of the most invigorating conferences I've been to. It was awesome.
Yeah,
so permissionless will be equally as sick.
Okay,
very bullish Blockworks conferences. So guys, get your tickets.
Glad we plugged that.
There you go. Nice plug. Way to set me up for that. Thank you. All right, guys. Have a good weekend.
We'll see you.
See you guys.
Later.